Hi again, everybody. This is Ken Weber, president of Weber Asset Management. Today is Thursday, January 27th, 2022. I'm here with my business partner and pal, Jack Bowers, who's out in, where are you, Jack? Lake Tahoe, right?
I'm in the Reno office.
Reno office. I should know the background, but
Yeah, our lease still runs for a few more months here.
yeah, Jack has had some changes in his life in a very good way.
Yeah. Be moving everything.
Right. We have a lot to cover, so let's get right to it. Today, we picked this day about 10 or 15 days ago to do this session, and today turned out to be a very busy news day from a financial perspective. Just this morning, we got the news that the U.S. gross domestic product, GDP, grew at a surprisingly high and robust 5.7% for the year. For last year, and that's the biggest increase since 1984. So that took a lot of people by surprise. It's basically good news. It means the economy has recovered a bit faster from COVID and all the problems than many people expected. However, with everything in the stock market, it's a double-edged sword. And I'm going to turn it over to Jack to explain the good and the bad of what a robust GDP means to us.
Well, it's a little bit like it was back in the 90s and the 80s, where people were fearful of the Fed causing a recession. And so a lot of times in those periods, we got into a situation where good news turned into bad news for stocks. And I think we may be revisiting that right now. The situation that I see is that we have interest rates currently on the 10-year Treasury around 1.8%. And if you look at the 10-year break-even rate, it's only about 2.3, 2.4.
Explain what you mean by 10-year break-even rate.
It's an inflation expectation that is derived between the inflation-protected bonds and the 10-year Treasury, the traditional one. And you can do some math to determine what the market thinks inflation will be. And the Fed tracks that on a daily basis. So 2.3, 2.4 really isn't that high. The bond investors believe this situation we've got is very temporary and that we'll quickly go back to a low inflation scenario. So the risk here is if the bond investors are right and the Fed is too aggressive, the Fed may put the economy into a recession if they go too far, and they are talking like they might go too far, and that has made everybody very nervous. And so there's a lot of profits being taken off the table right now.
And certainly today, the day we are recording this, the market started the day very strongly, and then pow, it's plummeting right now at well, we're an hour before closing time in the New York Stock Exchange. Time will tell. This could be a temporary, as we've seen for the last couple of weeks, a temporary blip where we just had a few days ago where the market went down, the Dow went down 1,000 points in the morning and ended the day up. So this may or may not be one of those temporary blips. Jack and I talked about this Fed thing. He's a bit pessimistic about the Fed's action, and as he rightly pointed out, the Fed does not have a great track record of finessing the interest rates in terms of the economy. But my reaction to that is it's a different Fed. And I think Jerome Powell and some of the other people are totally aware of everything you just said. So I'm hoping that they have learned the lessons of the past and they won't make those same mistakes. We do know for sure there's one, almost certainly three, probably four interest rates in the next 12 months. Interest rate hikes.
Quarter point hikes, yes.
Quarter point hikes in the coming 12 months or so. There's talk of 6 instead of 4. Personally, I'm thinking it's going to be 3 and likely 4, but I don't think it's going to go beyond that. And I think if the market gets its head around that, even the full 1% rise is not the end of the world. We've been through many scenarios, Jack and I, we'll talk about the many scenarios we've been through, where we've seen interest rates go up and the market can climb that wall of worry and climb while the interest rates are going up. Right, Jack? I mean, we have seen that.
Yeah, I think at this point, the market isn't so much worried about the next few quarter point increases. They're worried that the Fed will do more than they need to do to rein in what is likely to be a temporary inflation problem, and actually flatten the yield curve and put the economy into recession by going too far. It's the history of the Fed is that they react too late to inflation, and then when they finally do react to it, they come on too strong, and then it's made the soft landing, the so-called soft landing, very hard to achieve historically. So I'm worried that we're revisiting the same thing that went on in the 70s to a degree, with an inflation problem that is not nearly as serious. So it just calls for caution, which is why we pulled back risk in our more aggressive portfolios.
Well, that's a great opening for you to talk about. We're not going to talk about specific portfolios. We have more than 20 at Weber Asset, but give us a sense of where you are with the fully invested portfolios in general.
We're roughly split between growth and value, and in the lower risk portfolios, we have a bias toward larger cap stocks because that's what's really performed well during this whole labor shortage scenario. The larger companies have the scale to get the people they need and get the parts they need to navigate the supply chain issues. And the market is, currently rewarding those companies and punishing the smaller companies that aren't profitable and that may have a more difficult time in this situation. So relatively large cap, our more aggressive portfolios have, especially the selects have more mid cap and small cap exposure, which has been a difficult situation over the last 12 months. And additionally, they have higher risk scores than the market overall. And when you're in that situation in this environment, it can be a problem. So by taking our aggressive portfolios down to a relative volatility score of around 1, which is
meaning roughly the same volatility as the S&P 500.
Yeah, we measure things with standard deviation over 36 months. We try to track our portfolios and keep them close to their risk targets. Our higher risk portfolios typically have a 1.2 neutral risk target, but we've made a decision to run below that at around a 1.0 while we see how this whole tightening cycle with the Fed plays out.
The good news about taking it down to 1.0, which you talked to me about it before, you always ask me about the trades before we do them. I agree that this is a good time, but the good news is we're really not losing anything. If the market goes up and we're same volatility scale as the S&P 500, our clients go up with it. The client portfolios go up. So by reducing the risk just a bit, I think we're in good shape. All we're giving up is if the markets do surprise us and shoot up ahead, we may not have spectacular gains, but we should have healthy gains.
Yes, by becoming a little bit defensive, we hope to limit the downside a little bit so that it's not a whole lot worse than the market, and that just makes it so much more easy to recover when the recovery period finally comes. For
those of you who aren't sophisticated investors, maybe not paying attention for the last few decades, it's kind of ironic with stock market action. The economy now is very strong. We had that great GDP number. Unemployment is down to 3.9%. That should be good for the economy. Well, it is good for the economy, but for the stock market, it sometimes causes the opposite reaction in general, because as Jack has been saying, that causes interest rates to go up. Interest rates take money away from stocks towards fixed income. And so there's that balancing act that happens. But on the other hand, the stock market can go up in the face of rising interest rates.
Yeah,
Jack and I, by the way, I'm sorry to interrupt. I just want to point out before we do run out of time, Jack and I are celebrating our 30th anniversary of working together as partners in Weber Asset Management. I don't have any champagne, Jack, but cheers. Congratulations.
Doesn't feel like a day where we'd want to do a toast.
Every day is
not in the market.
We're celebrating the GDP. That's what we're celebrating.
Yeah.
But the point I'm making is that over those 30 years, Jack and I and our clients have seen many, many downturns. And the clients who have stayed steady with us, stayed within the program, have done, I can't guarantee anything for the future, but looking backwards, the ones who have not panicked, stayed the course with our programs that we've set up for you, have done very well. Jack, you mentioned earlier before the call, how many major bear markets do you think you've experienced with
Well,
Weber Asset?
the tech bust and the financial crisis was the
Those are the big
big
ones.
ones.
We had like
But,
3
you
or
know,
4
there were
major ones.
some minor bear markets in there that had fast recovery times, at least 2 of those, and then probably a dozen corrections. So,
Of 10 to
and-
15%.
you know, generally staying the course does the trick. It's just a question of how long does it take to recover. And most times when you have a sell-off, the recovery period tends to be less than 2 years. Just the 2 major bear markets that took 3 to 5 years, I think, were the worst case situations. So,
But in fact, as I showed you, Jack, before the call, is that CNBC published a chart, and I took a snapshot of it. 10 to 20% recover, 10 to 20% declines. The average recovery time was only 4 months.
that sounds about right.
Yeah, and that's 10 to
Been some
20% drop.
significant bear markets that had less than a 4-month recovery. The 87 crash, and then also the 2020 sell-off when the pandemic hit. Both had less than 4-month recoveries.
And the thing about a downturn, I just want to remind everybody, there's not going to be a sign that is pulled up and say, you know, it's coming. It may start next week. It may start a year from now.
Yeah,
We will
that's
just
why
never
we
know.
stay fully invested, because we really don't know when it turns. You know, it could turn, it may already be over. It may run another year. In this situation, it's just very tough to know, because you don't know what the Fed is going to actually do yet.
Now, we can't not ignore the pandemic. It's still out there. It's still affecting some people. It's now in its 3rd year. Who would have thought that this is still affecting us? But it seems like we're slowly getting back to normal in more and more places. The vaccinations have taken hold in most places, and you know, the new variants don't seem to be as aggressive as the earlier ones. And so hopefully, maybe by the next time we do one of these sessions, we'll really see some true light at the end of the pandemic tunnel.
Yeah, I think for the US and Europe, where the emphasis is on vaccinations rather than lockdowns, we're already largely back to normal, and we'll struggle through this labor shortage and probably recover by the end of this year from that. I think there may be a lot of supply chain hitches that still play out. The chip shortage may not resolve for another year. I think the biggest risk is and it's kind of a wild card, really. China is pursuing this zero COVID policy to try and stamp out any outbreaks before they become a big thing. And it may still work with Omicron, which is more infectious, or it might not. It might cause a real kind of train wreck in the supply chains there. And on top of their real estate bust, that could really weigh on global growth. And that's yet another reason why the Fed doesn't need to act too aggressively, because global growth is already slowing as we speak. So there's a real risk that they might do too much.
And we have to at least mention that Putin has his troops massed on the border with Ukraine. And right now it's just at a simmer, but God forbid that turns into a boil. That will be a problem. The stock market.
Yeah, it's a factor in oil prices, no question.
Absolutely. It's a factor on many. It'll be
inflation.
Right. Many things will be affected if shots are fired, whether the U.S. I don't think we'll be involved with our troops, but if our allies are involved in any sort of shooting war, that will certainly spook the market. Hopefully that would be a near-term problem. But boy, we sure don't know. We can't predict this next few days, certainly next few weeks.
Yep.
So again, fingers crossed on the pandemic, fingers crossed on Putin not being totally crazy. And congratulations on the U.S. Pulling out of the depression, almost the near depression that we hit at the worst of the COVID nightmare.
Yeah, I think the economy will be fine. I'm not really
agree.
worried about it now. It's the stock market that is vulnerable with Fed.
And as we like to point out, the economy and the stock market are not necessarily the same, but
Right.
frequently not.
And the bond market is not the same either. I think we could see a scenario where the Fed becomes too aggressive and it flattens the yield curve, and that might actually benefit bonds, the ones on the longer end of the maturity curve. So I don't think the worry here is about bonds getting killed. I think it's mainly a stock market concern. So
Right.
we've largely stood pat on our bond strategy, which is kind of playing defense until inflation peaks, and then we may look for some opportunity on that side.
Your long-term track record, Jack, with bonds has been spectacular. It's been a little rough the last maybe 12 months or so, but your long-term record with stocks and also definitely with bonds has been quite good. Cannot guarantee the future.
Yeah, that's what I worry
from
about.
the SEC. But
Look
looking
forward,
back,
not back.
yeah, right. We always do the best. Okay, we're out of time. Jack, Happy New Year to you and your family, and
Yes.
to everyone on the West
Happy New Year.
Coast, and to all our loyal clients and prospective clients who might be watching this. It's great, and we'll see you next time. Thank you, Jack. See you. Bye-bye.
Bye-bye.